In a market that is up nearly 40% since Election Day, it can be tough for investors to find value. Our next guest has made a career out of discovering hidden value in the stock market, even being dubbed the value guru. You may know of his books that were big hits with individual investors over the decades, including You Can Be a Stock Market Genius and The Little Book That Beat the Market. Over the last year, his Gotham Index Plus fund has outpaced the S&P 500 by almost 6%. It is up more than 5% year to date, with more than $5 billion in assets under management. Gotham Asset Management Managing Principal and Co-Chief Investment Officer Joel Greenblatt joins me now from the Forbes Top Advisors Conference in Las Vegas. Good to see you, Joel. Thanks so much for joining us.
Sure, my pleasure.
So let's start off with where you see things here. Characterize for us the backdrop for investing. Obviously, the macro story has been pretty good, and how you view this market at current levels.
Sure. Well, the stock market is just a bunch of stocks added up together, and that's the way we look at it. And stocks are ownership shares of businesses. So we actually go around and value each individual business. So if you think about the S&P 500, got 500 stocks. They're weighted a certain way based on their market cap. And we value them daily, and we've done that for the last 27 years individually. And then we add them all up and rank them the way the market does. And right now, we're in the 16th percentile towards expensive over the last 27 years. What that means is the market's been cheaper 84% of the time, more expensive 16% of the time. Then we can go back and look at what's happened from this valuation level in the past. And what's happened is that from this valuation level in the past of stocks, year forward returns have averaged 3 to 5%, 2 year forward 8 to 10. So below normal, because the market's averaged about 10% a year for those 27 years. And this is 3 to 5%. And that makes sense because the market's more expensive than it's traditionally been. But importantly, not negative expected returns. Now, of course, we can't tell you what's going to happen in the next year. And the way we can get back to those 10% expected returns could be in a few ways. One, the market could fall 18% tomorrow. The other is it doesn't have to do that. It could just under-earn maybe 3 to 5% for the next 3 years. And then 3 years from now, we'll be back to 9 or 10% expected returns. So I can't tell you what's going to happen in the short term, but, it gives you a perspective of where we stand.
So with all of that perspective, Joel, where are you finding value in this market right now?
I just told you about the S&P 500. It's in the 16th percentile. Well, the Russell 2000, which is stock number 1001 through 3000, those are the small caps, that's in the 2nd percentile, meaning it's been cheaper 98% of the time over the last 27 years. So as you would expect, we're finding more value in the large caps, and the small cap index is expensive. We don't short that index. We short the most expensive stocks in that expensive index. So our opportunity set is really in small caps.
All right, so small caps have created opportunity, but they've gotten expensive. So you want to be shorting then small caps?
Yes, that's exactly what we do. So the opportunity set on the long side is in the large caps, and on the short side, it's mostly in the small caps, although there are plenty of high-priced. The market is expensive, even large caps. So in an expensive market, if we short the most expensive stocks, there are opportunities there as well.
Yeah, I mean, there was a lot of discussion about the small and the mid-cap area around the tax plan, because these smaller companies are getting a huge benefit having to see a tax rate, corporate rate, go from almost 40% to 21%. But it's the large caps today that you say you're finding opportunity. Tell me how the dollar fits into that, Joel, because as the dollar has traded up, that has been a negative for these international companies. But of course, we've seen such volatility, and most recently, the dollar's down. You think that continues?
Really, we don't think about the world that way. We're looking more long term. We're looking for earnings over years, and the dollar is not too far out of line with other currencies. If you look at a long-term perspective, what it's going to do in the short term, I haven't found many people are very good at predicting that. So we're looking at streams of earnings over many years, the next 5 or 10 years, and so what happens in the very short term is really not going to affect us.
Okay.
Some of the large cap companies have a lot of international business, some don't.
Yeah, I think you're absolutely right. And a lot of people recently have been talking about the emerging markets creating an opportunity. Europe, finally, we're seeing some growth numbers coming out of Europe. These large caps that you're investing in are benefiting from the recovery we're seeing across the world, correct?
Sure. That's true because a big chunk of their business is international. But We are very U.S.-centric in what we do, especially in the long-short portfolios where we don't have to balance currencies and trading costs and things of that nature. And so we focus mostly on the U.S. and, of course, U.S. companies do benefit from international business, as you know.
So do you think that this market has gotten ahead of itself? I mean, are you expecting the volatility to continue and, importantly, the declines?
Well, you know, we've had a actually very smooth, until most recently, very smooth period of time, which is not normal. And so obviously I think the volatility will pick up from what's happened over the last couple of years, and I think that's good news for stock pickers. You know, there'll be opportunities and discernment rather than just a steady flow up. So I think that's, for value investors like us, that's good news.
And again, when you find value, is it a specific sector, or are you actually looking at specific situations, stock situations? Can you share with us where the value is?
Sure. Well, you know, I can name a few longs that we like. Apple, as you know, the biggest company, but we still love it. You know, some people think it's just a hardware company that's going to crash and burn like all of them do. Other people say, no, it's a network. It's an ecosystem of products that play off one another. The answer is probably gray between those two, but it's trading cheaper than the market. It grows much more than the market. It's a very good business. They have a great niche. So we still love Apple, and we own a bucket of apples. These are things that gush cash, earn high returns on capital. We own Boeing, which is a duopoly. You know, there's really only one real competitor. They're selling cheaper than the market, yet growing faster than the market with a better market position. We're also long Google, which, if you take out the cash, is trading well below the market, and obviously it's a great business. So, you know, some of the big names, believe it or not, are still relatively good values.
You know, it's interesting to hear a value manager talk about technology. For the longest time, we thought about these tech companies as the growth stories, not the value stories. But you're right. You look at Apple and what it's trading at right now, and it's got to represent value because it's trading below the broader market.
Well, besides the fact that even Warren Buffett likes it, what's good about it is that it's really got a pretty sticky business. It's got a brand name that people love. You know, Coca-Cola's been in business for a long time, and it's just sugar water, and but people like the brand, and so Apple has that going for us. But more importantly, it's also an ecosystem of products that work together, and so it's far better than the average business. It gets much better returns. It's got a loyal fan base, and so if you can buy that cheaper than the market, that's at least on a relative basis a good deal. And so we like it. Boeing, as I said, is a duopoly. That's, you know, very hard to create that, and big barriers to entry. So, you know, also a great business, and everyone knows about Google that even though it's a little cheaper than the market, it's much, much better than the average business and much stickier business. So these are great relative bargains and should get us reasonably nice returns better than the market.